and Brent crude oil closed last night over $80 and first time in a while, and as holding that this morning in early Asian trade, although nothing too dramatic happening, but nonetheless breaking through 80. I think in the context of where we've been sitting in the doldrums, if you like, where there's been no real momentum in the oil markets, except really a downward draft, you'd say, the trend over the second quarter, whenever there was no oxygen in the room, the market wanted to go down. Now it seems that we're moving in the other direction with some floorboards of supportive foundation underpinning it. Let's go to Ole Hansen, Head of Commodity Strategy at Saxo Bank in Copenhagen. And Ole, your thoughts on whether we have moved now into a post-Fed rate tightening cycle consciousness in the markets, even though there may be another one or two, the markets are moving beyond. Your thoughts?
Well, good morning, Sean. Well, I think the market is once again perhaps just running a little bit ahead of itself. We saw that recently when the FOMC had to come out quite hawkish at the FOMC meeting, highlighting the need for further rate hikes, just simply to take the steam out of the market's expectations that the cuts were just about to happen. I think we probably have to be a little bit cautious once again. But obviously, we have inflation coming down, and we still have some strength in the data, which makes this a bit of a tightrope for the Fed to walk. But most certainly, the risk appetite is back across markets following that lower print yesterday, and it's also supporting the oil market, which was already gaining some positive momentum, as you mentioned.
Andrew Critchlow, Head of News at EMEA, S&P Global Commodity Insights. Andy, what are your thoughts on whether this is a demand-led move out of the 75 handle now above 80? Is this upward momentum driven by demand and the positive economic outlook, or is it driven, do you think, more prominently by the restriction of supply that particularly Saudi Arabia has imposed on the market with its unilateral 1 million barrel a day cut?
I think it's fair to say it's a combination of both. So we had some very positive data out of China this morning. Year on year, crude imports up 45.3% to 12.72 million barrels a day. Of course,
for June.
Yeah, for June, very important for the market overall. It's a 3-year high. Of course, there is a caveat to that. You know, our Chinese refiners, buyers, loading up in June when we had a period of weaker prices. Overnight in the US, coming out of the US, there was some better than expected inflation data. I think that has tempered fears that you're going to get a much more extreme reaction from the US Fed to inflation for the back end of the year. You know, maybe we won't have the nightmare scenario of kind of stagflation, recession in the world's largest economy. So again, positive for prices. And, you know, in Europe, you've got a resurgent aviation industry sucking up every last gallon of jet fuel that they can get at the moment as everyone goes on their holidays. Seasonal demand kicking in. So a rising tide lifts all ships, and that's very supportive for dated Brent crude. Physical market closed as well above 80 yesterday in our market on close process, which is significant for dated Brent. So it seems that there's been a bit of a turnaround in sentiment. And then obviously on the supply side, you've had a lot of signaling and action from OPEC and OPEC Plus on cutting production, but you know, the proof is in the pudding there, and what we see at the end of the July in the data.
Sarah Akbar, Chairperson and CEO of Oilserve Kuwait and Non-Executive Director of Petrofac. Sarah, I was at the OPEC seminar in Vienna last week, and the Kuwaiti oil minister was telling everybody that Kuwait are certainly looking to try and increase production and catch up with others. Your thoughts on the outlook for Gulf OPEC states to continue to add new supply? UAE have been very successful at it. Where do you think the others will go?
Well, I think, Sean, everybody here is there's a huge amount of investment going into the oil and gas sector. Not only, I mean, in UAE, but Saudi. There are massive projects coming now online now, and many projects were delayed last year. Last year we were expecting to see much more than what we saw. But there was delays in actually sanctioning investment. But now this year, since the beginning of this year, we have seen many projects being sanctioned, and the investment is really going back into the cycles. So this is a bull cycle really for investment and for all kinds. Everybody now is looking to invest more. So for example, in Kuwait, for sure, we have now something like 138 rigs. We are going to like 160 rigs to drill more wells. There are more development plans that has already taken the move. In Iraq, same story. Mostly, they are working on developing and of course now they signed the Total deal, and of course they are in the process of this new exploration and development bids. So in Libya, same story. They have something like 45 projects. They have defined that they are going to expedite achieving the 2 million barrels. So you see from the upstream and the midstream, downstream, there is real momentum that is going now. And I think it's all because we are in that same range of 70, 80 dollar per barrel, which really encourages everyone to go in that same thing. So I think the biggest problem we will face now is the supply chain, because with all these projects coming at the same time, we do this mistake every time in the industry. All these projects come at the same time. As a result, there isn't enough space in the manufacturing and the transportation and so on. And as a result, things started to get more expensive and there will be more delays. But we are in that cycle now. And it is
What about, Sarah, the fact that the major Western oil service companies, Halliburton, Schlumberger, and so forth, obviously you're part of the regional oil services supply chain, but the fact that the global large players have pulled out of Russia, does that increase the capacity available for the Gulf states development?
Well, you see, the problem is in Russia, these companies hire Russians and most of their staff is from Russia. And they just cannot mobilize those people. Those people already now have their own, the Russians are very smart in the way they do this, so they take it over and they run it as it was. So you think this is Schlumberger, but the reality now it's a Russian company of some kind from the same people who used to do it when they were Schlumberger. So I don't see that this huge movement, and like I said, the two resources that we are really worried about now is having access to good people, and the second thing is the logistic, the supply chain. Supply chain is a serious issue that the industry doesn't have the capacity at this point in time to execute all the projects that we have worldwide.
Ole, we started this year very much with the narrative, a year of two halves, with China due to come into the second half and sort of eventually get its mojo back after the COVID crisis. Is that what we're seeing now, or is this something different? I mean, China doesn't seem to be the engine, but yet it's importing a lot of oil, or at least it did last month and previous months. Certainly cheaper oil. You wonder if that continues. But your thoughts, Ole, on the narrative, a year of two halves, the second half being a more robust one, and that maybe is what's already starting to happen?
Well, I think it most certainly is, Sean, and I wrote in recent updates that the coming quarter, so this quarter could be a make or break quarter for the oil market, simply because we have so much of the anticipation in terms of demand growth priced in to occur during the coming months. We got the OPEC report and the IEA report out today, and we're also looking for maybe some additional guidance there. If they still see this robust demand growth coming over the coming months, then clearly we will move into a deficit, and that will underpin prices. And at some stage, leave room for Saudi Arabia to put the barrels back into the market. So it is potentially going to shape up as a two halves, and also just considering what's happening in China, we still think that they haven't unleashed the bazooka yet. We think they have to. It may not happen until towards the final quarter of the year, but some additional stimulus could be on the cards in China as well. So I think the main focus now over the coming months potentially could be how Saudi Arabia successfully managed to get the barrels back into the market, because obviously if demand is not there, then they'll have to wrestle market share away from whoever took that market share during the production cuts. So that will be an interesting one to follow. But at this stage, it looks like there will be room enough for those barrels to be added back into the market and not having a large negative impact as such.
Andy, you long-time OPEC watcher. I came away from OPEC last week wondering if OPEC Plus was stronger rather than weaker, trying to interpret the need that Saudi Arabia for moving outside of the group, Russia supposedly as well. How important and how robust do you think the OPEC Plus unity is, Andy, going forward, if the action that has to be taken is outside of the agreement, and an incredible, you would say, gift, if nothing else, from Saudi Arabia to the rest of the market, including the international energy oil companies who are also benefiting from Saudi's gesture. But your thoughts, Andy, on the robust solidarity of the OPEC Plus when the deals are having to be done outside the room, so to speak?
Yeah, I mean, I think it comes back to Sarah's point about what she's seeing and what oil and gas engineering companies are seeing in the Middle East in terms of expansion. It really is the only region where you're getting significant expansion into capacity, whether it's the UAE, whether it's Saudi, Kuwait, all over the region, Iraq. OPEC, our latest production survey, OPEC Plus, 41.34 million barrels a day. That's a huge chunk of an oil market, which we see growing by 2 million barrels a day to 102.6 million barrels a day by the end of the year. Lots of market share. Coming back to the point around investment and expansion, I think this is actually key. You're going to have, once we get to the end of what's happening in Ukraine, and eventually there will be some settlement, there will be some resolution, whatever that looks like. And we return to some form of geopolitical normalization, some form of global economic normalization. Wouldn't that be a great thing? Then, I think that's when this question becomes very pertinent and relevant, because at that point, all these major producers in the region, the likes of the UAE, the likes of Saudi, the Kuwait, etc., will be sat on huge excess capacity, which they're constrained from producing due to the current OPEC policy framework around restraint. And historically, OPEC has seen Russia and Russian Urals crude as a major competitor for its market share, whether that's in Europe or increasingly now in Asia. We started the segment talking about Chinese demand and how that has surged over the previous month. That's buying, cheap Russian crude that you can load at around $60 a barrel, the price cap, compared with what buyers are paying market rate for when they're buying volumes from the Gulf.
The big question there, Andy, is whether China indeed goes beyond where it is. I mean, ultimately, China's just getting back to where it was.
Yeah, absolutely.
So whether it moves beyond that point.
That's exactly it. And then I think that when we get beyond this, then all these tensions that previously were the case before OPEC Plus existed between Russia and the OPEC producers, they haven't gone away. They're going to come back. And at the time where Gulf producers are investing heavily, we're talking billions and billions, and that they need to get this cash back at some point. At that time when this is happening, nothing's happening in the Russian oil industry. Russia is just keeping itself afloat in terms of production. They're not expanding fields. They're not finding new fields. They're not doing huge exploration. They're not investing. So, you're going to be at a time where Russia's going to be racing to catch up once everything in Ukraine is settled. And the Gulf producers are going to be wanting to produce that spare capacity. That creates a potential clash within this group over how you manage that, because there is a disconnect. And I think that that's when we may start to see some tension come into this agreement. And members of OPEC may start to then ask the question, well, does this suit our national interest? Is it in our benefit to have this agreement with Russia going forward? And in Moscow, probably they'll start saying, well, actually, we don't want to be constrained by OPEC production cuts. We need to be producing every barrel we can now, because we've got to pay for this war that we've just either won or lost.
It seems that conversation might be a little way off in terms of where the war goes, and to be sort of in a post-war consciousness. But Sarah, looking at that sort of duality ultimately, and we are in it right now in the context of we're cutting supply, and of course Saudi has made this unilateral cut, but before that, since October, everybody has participated, well, certainly the big producers have all participated in cutting supply. I think it adds up when you put it all together in the bucket, 4+ million barrels since October. Sarah, so what is the duality of this coexisting cutting supply, and yet, as you've just articulated, everybody in the Gulf is spending and digging as much as they can to add capacity at the moment? How long could those two things coexist, do you think?
Well, I think, if you look at the history, we have been through these cycles where something happens somewhere and you have somebody out of the market, and then everyone makes the benefit having this surplus. And you remember we used to talk about Saudi being the swing producer for a long time. So, I mean,
although anytime you mention that now, they jump back from it, even though technically you could say they're doing a little bit of it, but don't expect it to continue is kind of the message from Riyadh.
Yeah, but so seriously, I think for the oil industry here, we've then learned the lesson. You have to develop your fields. You have to be ready, because you really don't know what happens in the market. Who expected Russia to invade Ukraine and cut off all this mess? So the world is not so stable to the point where we say, okay, we have $80 a barrel for the next 50 years flat, and then we will all be happy and everyone will not do anything. But it is not the case, and it's been fluctuating, and things happen dramatically sometimes. And there are few things that that happen that impact us as well. For example, now we have, I'm sure you know about it. So Kurdistan is outside. 400,000 barrels of Kurdistan is off because there is this dispute with Turkey, and they can't export through that pipeline. But now some of that crude will be produced and shipped from south of Iraq. Now the Iranians have agreed with the Iraqis that they will swap. They will give them gas, and the Iranians will take oil instead of the payments because they can't take the payment. So this will actually stabilize the production in Iraq, and it will, bring back some of that Kurdish crude that they lost. Now there is a dispute between Kuwait, Iran, and Saudi on the Durra field. So there are some moving parts which create some kind of instability in the market as well. And as a result of that, I think the lessons we learned throughout time is that you need to be prepared and ready. When there is demand, you have to be ready and supply the market. When the oil price goes up, that's the time we benefit from, from the high prices. Yeah.
You mentioned Iran there once or twice, and I wanted to come to that question later, but as soon as you've mentioned it now, is it your sense that the Iran-Saudi rapprochement is now anchoring in across the region, and we're now in a kind of a new situation, a new paradigm, or is this just some sort of blip? Your thoughts on how sustainable this Iran-Saudi rapprochement is to allow for all of these kind of deals that you're talking about?
No, I think, it's a very stable relationship going forward. I think both countries realized eventually that the best thing for the region is if we work together rather than fighting each other. We cannot afford to go into conflicts anymore. And as a result, you see some women. Yemen is being worked out, Syria is being worked out. So yes, it is now that we can see the impact and the influence, which is beneficial for the whole region. So yes, there will be small things here and there, but the basis for the relation, I think, is strong, and it will continue to go in that direction, except, of course, if things happen, the Israelis decide to hit the nuclear plant in Iran or something happen, those kind of scenarios can throw things off the road again. But for now, I think, everyone is seeing the impact of this mending this relationship with Iran. So we are hopeful that, through this as well, we can sit together and finish the Durra issue that is come up now and just move on.
Let's go to the survey question, which sort of tackles the point we discussed a little earlier, which is the sort of moving into a post rates tightening cycle. Markets, including oil, I mean, the equity markets seem to have moved into post-Fed tightening cycle some time ago, but now oil is joining the party. Is indeed that the case? That's what the question we're asking. Markets, including oil, have now moved into a post-Fed tightening cycle. Agree or disagree with that thesis? Ole, on that point, ultimately, in the last week, not much has changed. There's been this data point out of the US and an indication that inflation is, at least on the consumer end, getting under control, but core inflation still locked at 5% in the US. Europe is still fighting a higher inflation rate, as is the UK, that did a 50 basis point hike last month. Where is this recession, Ole? Is it still out there? Is it still coming to a cinema near you? What's your sense of where this rate hike cycle inflation battle goes now into the third and fourth quarter, and the messaging we're likely to get from the monetary policymakers?
I think, first of all, on rates, as I said at the beginning, I think it's we probably have to be a little bit careful about not completely looking beyond the current rate hike cycle. I think we're not done yet. Well, obviously the swap market shows that we are not done. We will see another hike. But I think that we could potentially see more hikes yet, because, as you say, core inflation is still sticky, and the question is really whether they are how comfortable they will be with that kind of level over the coming months. So I think they will probably continue to send out a bit of a hawkish message, and that means that we probably may be getting just out of the starting blocks a little bit too soon here. But we should not disregard the momentum in the market. Momentum has been favoring higher prices now for a while, and that potentially could carry it a bit higher than where we see it now. Recession is something that we think will be avoided in the US. It's difficult to see how the strength in recent data can suddenly flip around and trigger, and we move into a recession. Europe a little bit more concerned, especially countries like Germany, where the weakness is still shown, and we can also see the gas demand is nowhere near where it was. So the industrial activity is under somewhat pressure there. So we're not out of the woods regarding a recession, but I think the overall impact on the global economy is going to be less in terms of the demand for commodities than perhaps was feared just a few months ago.
Is it somewhat surprising, Ole? I mean, or how do you sort of read the tea leaves on the fact that such a massive adjustment in the price of money over 1 year has not had a greater impact on economic activity in the G7, well, particularly US and Europe, and Australia as well, and other economies, Canada? What's your explanation on that? And does that continue to be, this sort of nearly seems like parallel corridors, because the markets seem to exist in parallel corridors with the same frame of mind, that these rate rises, as dramatic as they are not impacting the real economy in a substantial way?
Absolutely right. And I think we just need to look at the stock market and see what's going on, because really when your funding cost goes up to the extent that it does, you need to adjust your forward earnings, and the market simply is not buying into that it will have a negative impact on forward earnings, even though funding costs are rising. So you could argue that we have a disconnect somewhat right now. And what's going to give that obviously will be shown over the coming period, but there is a lot of savings built up during the past decade from the rallies we've seen across assets, and I think that's still holding this market together. We have a boomer generation which is starting to spend cash instead, and that will probably also prop up spending, I would say. And at the same time, as a lot of people leaving the workforce, then it will continue to create tightness in the labor market. So overall, we're puzzled by the strength in the stock market relative to where interest rates have gone and the limited impact. So not really answering the question, but
yeah, but it's
basically agreeing that we have an issue here.
They're pointing at some unique sort of data points that make this maybe moment a little different. The baby boomer retirement thing is certainly an interesting one. The big resignation, other issues there that can coexist. Andy, we're getting into that point. We wanted to get everybody's views on the sort of summer ahead. Everybody's going, at least we're going on leave. Tomorrow's our last show until September. The big season ends and we take a break. But I wanted to get your sense of what you'll be watching. What will be, other than the Tour de France, that will give you signals as to the direction of travel, you think, over the silly season?
Well, I'm certainly going to be watching the Fed meeting at the end of this month. We expect a 25 basis point hike. I think that the release of the Monetary Policy Committee's minutes following that will be important to signal kind of where they go. I'd kind of echo a lot of Ole's comments on that. I think my experience as a reporter of oil, financial, economics over the last, 22, 23 years now, is that these things, these big kind of economic shocks, these big policy shocks and movements that governments make, it takes a lot longer than we expect to transmit into the real world. And I have a suspicion that a lot of what we're seeing now in terms of, the rising cost of money, Ole made reference to this in terms of companies adjusting forward earnings, equity markets reaction, etc., and even the geopolitics. We will see the effect of all of this into next year. That's when it really starts to, I think, transmit through to, core things like household spending. And that ultimately will have an impact on oil markets. For this summer, I think it's all about demand. You obviously have stronger demand in China. We're getting stronger demand here in the Atlantic Basin. You just got to look at refining margins, which have stayed very strong in the US and Europe. We expect them to remain so Q3, Q4. That is because there is a deficit in capacity in the Atlantic Basin because, without the Middle East and Asia, those volumes of products coming in to replace what we lost from Russia, there'd be a real problem here. These problems haven't gone away. This is a sticking plaster. So, as we get into the winter, first quarter, second quarter next year, that's when, as I said, some of the impacts of what we're seeing in terms of policy, in terms of geopolitics, in terms of economic fundamentals now, that's when we may start to see some clarity of where we're heading, and it may not be great.
Sarah, your thoughts on the outlook for the summer period? Obviously, the Gulf has, in some ways in recent years, continued its momentum through the summer. It's no longer as a downtime as it used to be. But what do you think you'll be watching to indicate whether this $80 Goldilocks will sustain?
Well, Sean, this summer is very, very hot. This is what I can tell you.
Exactly. The ACs are...
It is super hot.
Well, it's hot everywhere. It's hot even in most of Europe, 40 degrees, and they don't have AC. I was just in Vienna, as I said last week, and it was 30 something, and my goodness, it felt like 50 because there's no AC there.
So we hope that, since this weather is so hot, that, the prices will stay around the $80 where, all these projects that we have sanctioned now are based on a kind of $70 benchmark. So I think we will continue the momentum. The train has actually left the station now for many of these projects, so there is no turning back.
Where do you think Kuwait can get to over the sort of medium term, Sarah, in terms of additional capacity? We do have this UAE targeting 5 million by 2027. What's the sort of realistic outlook for Kuwait?
I think Kuwait can get to something like 3.3 million 3.4 max within the next, the short term, like 2-3 years. That's where we can
From where
achieve.
to where now?
Currently, we produce about 2.6 million, and I think that the capacity is about 3. So some additional capacity from the divided zone, but I think we can get to 3.3, 3.4 million within the next 2-3 years.
Ole, last word to you with the survey result. What do you think is the big one data point that you can't miss over the summer in order that would give some kind of agree the markets have moved beyond Fed? Ole, your thoughts on what is the big data point that you can't miss over the summer to have some, singular guidance as to where the momentum of travel is?
Well, I think considering that the setting of rates in the US remains such a key anchor or key driver for global activity in general, we just need to continue to watch the same economic data that the FOMC is watching to get some further guidance on what their thinking will be in the future meetings. I think we also have to just remember that we are getting into the sometimes what we call the silly season. It's low liquidity, but then potentially high volatility, simply because the hands at deck to react to price or to news is limited. So I think we can still expect plenty of fireworks in the coming weeks.
I'd certainly be watching the Saudi data point out of China that gives some sort of clarity indeed to the momentum of the recovery there. We had the big sort of bumper import number last month. Does that sustain through July or some other data point like that gives a window on China, at least a data point that you can rely on? That will be one to also watch, I think. But inevitably, the notes coming out of the Fed meeting would be a critical indicator to where they're thinking beyond the summer. Listen, thank you so much. 3 great speakers as always. Really appreciate your participation this season. Ole Hansen of Saxo Bank, Sarah Akbar of Oilserve Kuwait, and of course, Andy Critchlow of S&P Global Commodity Insights. Your contributions throughout the season are much appreciated and always of great value to our audience. So we wish you a great summer break and look forward to getting back together in September. All the best, guys.
Thank you.
All the best.
Thanks a lot.
Bye-bye.
Bye. Bye.